Hey, what is up guys? In this video, I will share with you 7 key economic indicators that you as an investor should know and hopefully track it to level up your investing game rather than just solely relying on the performance of an index like the S&P 500 index. Macroeconomic indicators are essentially a form of fundamental analysis that can help you to understand what is happening within the stock market, as well as giving you a general overview of the entire economic health of any given country, which in turn will help you to assess your investments even better for the short, medium and long run. By the way, in case it's not obvious already, there are hundreds if not thousands of economic indicators out there that each serve their own respective purposes, so there is no such thing as one perfect indicator that does it all. What I'm presenting in this video are the top 7 indicators which I think would help you to connect the dots better when it comes to understanding the current state of the economy and to an extent predicting the future course of the stock market. Before we begin, can you help me smack the like button down below? That will help me to create better content for you guys. Thank you so much. So without further ado, let's dive right into today's content. The first and the most fundamental indicator for the US stock market, or just the country in general, is the Federal Funds Effective Rate (FFR), which I've covered extensively in my previous video, so I highly recommend you to check that out for a more detailed explanation. Very briefly, the FFR is the interest rate at which banks refer to for overnight borrowing, and that has a ripple effect towards the US economy, if not the world economy, because the US dollar is the reserve currency of the world. Interest rates have long been a way for the US Federal Reserves to calibrate and control inflation. When inflation is too high, the Feds will increase it to slow down the economy and bring inflation down. Vice versa, when inflation is too low, the Feds will decrease it to stimulate the economy and move inflation higher, which is what we are experiencing right now during the pandemic, even in 2022. You can find it from this Fed website. Don't worry, I will link everything down below in the description box. As you can see, we are currently at near zero interest rates, which is usually the case during a crisis such as the 07-08 subprime mortgage crisis, as well as the most recent pandemic crash in 2020. I'm not gonna lie, it's nice to have near zero interest rate as an individual because the valuation of stocks or just businesses in general will inflate, which means better return for our investments. But this is not sustainable, as the repercussion of prolonged low interest rate environment will follow with a higher inflation, which, as you can guess, eats away at your spending power as well as the long-term valuation for most businesses. And speaking of inflation, this is the perfect segue for the second economic indicator, which is the Consumer Price Index, CPI. Whenever we talk about inflation, or when you read the news online about high inflation, they are usually referring to the change of the CPI, which is the weighted average price of consumer goods and services such as food, transportation, medical care, and etc. This CPI data can be found on the US Bureau of Labor Statistics website. And zooming into this box here, you can see that the weighted average inflation of all items stands at 7.9% year over year as at February 2022. Or in other words, the CPI in February 2022 is 7.9% higher than the CPI in February 2021. For your information, a healthy CPI inflation usually hover around the 2% mark. So now you can imagine how bad the current economy is when we have 7.9%. That's almost 4 times as bad. Anyways, this CPI data is released on a monthly basis by this website. So if you see yourself as an investor that invests his or her money to win over inflation, then this CPI data should be something that you keep yourself updated to from time to time. You can also refer to this data on the Fed website, as it shows you the CPI trend over time, which is really helpful in my opinion. So now you know, when you hear people talking about inflation of 7.9%, they are usually referring to the Consumer Price Index, unless they specifically mention about the inflation of Producer Price Index (PPI), which is our third economic indicator of the day, and this number can also be found from the same websites. The PPI is the opposite of CPI, as it measures cost from the seller's point of view, which can be further divided into 3 different levels, which are PPI for commodity, which shows the average price change for commodities like crude oil, wheat, precious metal, and etc. Then we have PPI for industry, which measures the production cost at industry level, such as the plastic industry, construction industry, and etc. And lastly, we have the PPI for FDID, which stands for Commodity Based Final Demand Intermediate Demand. Not sure why they have such a weird name, but it essentially measures the production cost of physical assembly and processing to make the finished goods for us consumers. Anyways, I know it can be confusing, so to make your life easier, all you need to refer to is this core PPI, which is the index of finished goods that combines the three levels that I've just mentioned, which you can find from investing.com, that shows you the data on a monthly basis. And as you can see here, the PPI in 2022 reached a high of 8.3%, which is far higher from the average 2 to 3% a few years ago. Hence why the absurd inflation that we are facing right now, as the cost from businesses will eventually pass on to consumers like me and you. The next indicator we have is the unemployment rate, which means the percentage of the people in the US that are jobless. And as simple as it sounds, when the unemployment rate is high, it simply means businesses or bosses are more reluctant to hire people, or they started to lay off workers in order to reduce their overhead costs because they feel that the current or future state of the economy is bad for their business. Hence, they need to be more conservative in terms of their spending. This data is usually reported monthly by the US Bureau of Labor Statistics as well, but you can also find it on the Fed website, which is what I personally prefer. And as you can see here, the unemployment rate as of the making of this video stands at 3.8%, which is fairly low considering we are in a high inflation and low interest rate environment. But I expect it to go up in a few months time as the US Fed starts to hike up the interest rates. Before I move on, just note that the unemployment rate is considered a lagging indicator, because businesses usually lay off workers when things are bad in order to cut their costs. So you would technically see an economic crisis unfold first before you will see the data for unemployment rate skyrocket. Just keep that in mind. So if you want something that can technically predict an upcoming economic crisis or recession, then we look at the next indicator, which is the Treasury yield curve. The Treasury yield curve is dubbed as one of the most reliable leading indicators of an impending recession, which I've covered before in my previous video. But just to give you a very brief idea, we have short-term and long-term bonds, and usually in a normal and healthy economy, the yield on the short-term bonds are lower, whereas the yield on the longer-term bonds are usually higher. Very simple. But when there is something bad happening in the economy, the yield on the short-term bonds increase, while the yield on the long-term bonds decrease. Hence, you will see the yield curve start to flatten because investors run towards the safety of longer-term bonds. But if the crisis continues to worsen to the point where investors can no longer take it anymore, they all abandon the short-term bonds simultaneously, which causes the yield curve to invert. Or in another word, the bond market is telling you that investors don't mind the low return on longer-term bonds because something really bad is unfolding in the current economy. So long story short, whenever a yield curve inverts, there is a high chance that we are entering into a recession. As you can see from this chart, every time the yield curve flattens and inverts, as you can see the light blue line touches the 0% mark, recession happens right afterwards. So for what it's worth, we are here right now. I hope this paints the picture as to how we could be entering into a recession very soon if the Ukraine-Russia conflict is not resolved and the oil price continues to skyrocket. The sixth indicator we have today is the Purchasing Managers Index PMI. Not something that you would typically see on the news headlines, but according to experts, the PMI is widely seen as an accurate and timely indicator of business conditions. Simply put, the PMI is a measure based on a monthly poll that the statistics agencies collect from the purchasing and supply executives across the United States. Or in layman's terms, they ask businesses what do they think about their business for the near future, and that data comes in the form of new orders, production rate, employment, and etc. So logically, if a business manager thinks the upcoming month will be good for their business, they will employ more, produce more, order more goods, right? Hence why if you aggregate this data for all businesses in the US, you end up with this PMI that gives you a glimpse of the future of the US economy across 18 different industries. I would recommend you to get this data from the economy.com website, which is backed by Moody's Analytics. And to help you to interpret this, usually PMI comes in the form of 0 to 100. 50 means there is no change for the business, whereas if PMI exceeds 50, it usually signals an improvement or increase from the previous month, and vice versa. If PMI falls below 50, it usually signals a decrease in business activities, which can also contribute to a recession. The last indicator on today's menu will be the business inventories to sales ratio, which measures the amount of inventories held by businesses compared to the sales they are making. Economics 101: when demand from consumers increases, the supply from businesses will increase. Hence, during a normal functioning economy, the ratio barely changes and will hover around the 1.2 mark, which means the business has about 20% more goods in their inventories compared to the sales they are making or expecting to make. Whenever there is an economic crisis or recession, the ratio will spike up because the consumer demand drops dramatically, which makes the businesses unable to clear off their inventory. Like for example, at the start of the pandemic, the sales of products like apparel, footwear, and accessories went down the drain because there's no point in buying them when you can't even go outside, right? So the same applies here. A rise in this ratio would signal that either the businesses stock up too much goods in expectation of a really good sales, or they can't sell off their goods as fast because there is a significant decrease from the demand side, hence the oversupply. This is again another form of lagging indicator. Not the best indicator to predict an upcoming recession, but it is a good way of telling you how the consumer behaves in the current state of the economy. So there you have it, the 7 key economic indicators that will prepare you better as an investor in this ever-changing economy, and also, touch wood, for the inevitable recession. I hope it's not too late by the time this video gets uploaded. If you ask me which indicators among the 7 will be a better one, I'd say the yield curve is probably the one that stood out the most as endorsed by experts, because they have stood the test of time and have proven itself to be one of the most reliable indicators of recession time and time again. But that said, that does not mean it will necessarily be the most accurate indicator of all. There are, as I've said, a lot more economic indicators out there. They all represent something, some way or another. It is our job as an investor to connect the dots and formulate a better educated guess so that we can attain better returns out of the market. I am by no means encouraging you to time the market by relying on these indicators, because I personally still firmly believe that time in the market beats timing the market. But from the information that I've gathered thus far, it all points to a very negative outlook for the stock market, at least for the foreseeable future. So I would try to reduce my exposure towards highly leveraged companies, as well as keeping a healthier cash buffer in case the unthinkable happens. Bottom line, I will remain invested in the stock market because timing the market will hurt our performance in the long run, if not managed well. And I'm sure 99.999% of us, including me, will not be able to time the market perfectly. Alright, I hope you found some value from this video. If you want to invest in the international market, US, China, Hong Kong, UK, whatever, I highly recommend you Interactive Brokers. It is the cheapest, the most flexible and reputable stock broker out there. Links down below, so feel free to check them out. And with that said, thank you very much for watching. Stay safe, stay invested, and as usual, I will see you in the next one.